We want to bring Deutsche Bank chief U.S. equity strategist and global asset allocation man in, Binky Chadha. Binky, it's good to see you.
Thank you.
Thanks so much for joining us. Your reaction to this Walmart story this morning?
So I think it's very important to keep in mind that, we've already had basically a very, very strong rebound coming from the business cycle. And we can talk about how and why that was happening, but that's because of things that happened a couple of years ago. And so if you look, for example, at the equity market, we are up a lot already before we come basically to tax reform, which the market really started to focus on in November. So in terms of, what corporates are going to do, and your question is really about, what just happened with Walmart, the big question is, what are corporates going to do with their higher after-tax earnings starting in the first quarter? And what I would argue is, they're going to do everything that they were already doing. So wages would have gone up anyway. I think it's important to keep in mind that the unemployment rate was already, close to 4% before we had the tax reform.
Right.
If you look at investment spending, for example, it had already taken off. We were talking about 8 to 10% rates of growth before tax reform.
Yeah.
We were talking a little bit about earnings before. Earnings are running at 14.5% is what we expect Q4 earnings to come in. That's before, the impact of tax reform.
Yeah, but wait a second, Binky, because during the commercial break, I asked you, what does 2018 look like pre and post a tax reform package? And you said earnings were expected to be what in 18? So
earnings, we were at up 11%.
And
so,
now?
And now I would say earnings add another 12%. So earnings for the year are really going to be more like 23%.
23% gain in earnings for 2018 is pretty significant.
That is correct. But I would also, quickly point out that if you think about S&P 500 earnings and think about them really longer term, bigger picture, there's a very, very, very clear trend line for the last 80 years. For most of this recovery, because we had a variety of shocks, some of them we were speaking about earlier, we're kind of sitting basically close to the trend line. The shocks took us below. Prior to tax reform, earnings were going to go up by 11% and would have sort of...
Now they're going to go up 23%.
And they're going to go well above the trend line, and that's what, equity analysts would call well above normalized levels.
Yeah.
And that means that when earnings are well above normalized levels, the market's going to put a lower multiple. So I would argue that there is an 11% or 12% impact on earnings coming from the tax reform alone, but as a result, the multiple is going to go down a little bit. So the total market impact is about 5 or 6%, and that's exactly the rise that we've had from the 2,600 round number in November until the third week when the market began to focus very, very acutely on tax reform.
Yeah.
So I would argue tax reform is fully priced in at the market level.
Into the market statement.
But I don't think that people saw actions like what we're seeing from Walmart. Let's just point out, which Maria said a short while ago, Walmart is the largest private employer in this country.
Sure.
There have already been about 130 companies, whether it was a JetBlue or a Verizon or an AT&T. We're talking about hundreds of thousands of workers in this country that are getting bonuses, if not running into seven figures in this country. With Walmart, for example, it's not just the $1,000 bonus, which I believe you need 20 years of service to get. It is raising, it raised its minimum pay to $10 an hour 2 years ago. Now it's 11. Your average full-time worker at that company makes about $14 an hour.
Sure.
This is an incredibly important story because it is going to the point, it looks like the estimates, particularly like by the Joint Committee on Taxation, all of the tax reform is going to drive up the deficits. It's going to be $1 trillion of the deficit. Those numbers, as we suspected, could very well be wrong in terms of the economic impact, in terms of the impact, the negative impact on our deficit, because these companies are coming out and doing things with this money to help their workers in ways that people did not anticipate.
Yeah, we didn't see this. We haven't seen this in years.
Yeah, I wouldn't disagree with that at all. I would argue that probably the tax reform has facilitated and maybe brought earlier what I would argue was going to happen anyway. Keep in mind that we are now you know, starting in March the 9th, we will go into the 10th year of this economic recovery.
So you think, what is it, 175 companies? I mean, you think 175 companies were going to announce $1,000 checks to employees?
No, I think the
regardless?
timing has been brought earlier, but the labor market, you know, unemployment's at 4%. Listen to any company talk about its earnings and its main issue, any survey, they will tell you it's a shortage of labor. So when you have a shortage of labor, you know, one of the things you do is bid up their compensation.
Do you think they would have loosened their purse strings in terms of investment, regardless? Because, you know, companies we know have been sitting on cash for 8 years.
Sure. It's definitely facilitated the timing, given the series of announcements, and that's, you know, positive. There's no question. But I would argue a lot of this would have happened anyway, and we can debate.
But if you're right,
not with the
regulatory
environment.
Whether we're set up for some sort of a sell-off in stocks or just kind of a flattening out after these gains that we've seen, if you're right. You know.
So on a sell-off, you know, the 2 or 3 really important things to keep in mind is the historical average behavior is that the S&P 500 tends to sell off by 3 to 5% every 2 to 3 months. We are currently in the 15th month without a sell-off. This is the longest rally since World War II.
So why do you think that is?
That's because if
it never happens,
so when I talk about it, people's eyes always glaze over because it's about something that happened a long time ago. In the summer of 2014, Mr. Draghi took interest rates negative in Europe. The U.S. dollar shot up by 25% in 9 months. That's the fastest rise in the U.S. dollar. Oil prices consequently collapsed. And we have been basically working through that shock. And what it's really implied is that by the late 2015, equity investors were positioned essentially ready for a recession. Now, our call was the dollar shock would pass. It did, and so we've seen a strong, big rebound in growth, and so equity positioning has gone from a low in this cycle, prepared for a recession, to now what is a 6-year high. So in terms of your question of when are we going to get a pullback, there are 2 necessary conditions in our view historically that have to be fulfilled. Number one is long equity position, and I would say that's a pretty big check today. The other is macro data surprises in growth, which has been the biggest driver really of the rally.
Well, they're talking about 4% growth for 2018.
Yeah, so it shouldn't be a big pullback. So we're just talking about a return to normal of a 3 to 5% pullback, which I would say, given the 14 or 15-month rally, people have just forgotten about. Yeah.
Do you see the administration forecasting that we're going to have a growth economy and create, obviously, greater revenue sources for the U.S. Treasury? Is that going to take place in your judgment?
I think basically we are set in this cycle for, you know, very strong growth late in the cycle. And that's historically very, very unusual. So, you know, if I was to look at, you know, historically periods when unemployment and labor market was tight and the ISMs were 58 or 60, you would find that it happens, you know, much less than 5% of the time. So we are in sort of a unique circumstance. We are in a unique circumstance, but for very good fundamental reasons. We spoke about some of them. And so I would argue, you know, things are going to get better anyway. I mean, things have already gotten a lot better.
It sounds like you're going out of your way not to attribute any of this to Donald Trump.
I think that it's just very early in terms of, you know, the tax and the deficit. I mean, at the end of the day, you know, what we are talking about is actually, you know, very small aggregate numbers. And so I wouldn't get too much into the decimals. So keep in mind that, you know, in one sense, I mean, the way that we do U.S. budgeting is relative to trend lines. And so we are talking basically about a $1.5 trillion, you know, increase in the deficit over 10 years. That's $150 billion a year. That's not a big number.
Binky, it's great to see you.
Yeah,
thanks so much. Binky
Chadha,
Deutsche Bank.